Assalamu alaikum. This is lecture number 17 of Global Business Management. The topic of today's lecture is Global Monetary System. We have 4 learning objectives for today's lecture. The first one is to understand the differences between fixed and floating exchange rates. Be familiar with global financial, currency and debt crisis. The third one is be familiar with the role played by the IMF and World Bank in the global monetary system. And the fourth one is to understand the implications of the global monetary system for currency management and business strategy. Okay, before we start today's lecture, first we'll quickly go through the major points of the last lecture. In the last lecture we had discussed about the international monetary system, which is referred to the institutional arrangement that countries adopt to govern exchange rates, and we had discussed about the floating exchange rate and the fixed exchange rate. And the floating exchange rate exists when a country allows the foreign exchange market to determine the relative value of a currency. And on the other hand, if we talk about the pegged exchange rate, which exists when a country fixes the value of its currency relative to the reference currency. Floating exchange rate is the exchange rate in which countries, the governments allows its market forces to determine the exchange rate of its currency with another one. And in the fixed exchange rate, government itself fixes the rate against other currencies. And the peg exchange rate, the government fixed the exchange rate against certain currency and allowed certain fluctuation to certain degree. That government might allow currency to fluctuate between 2 degrees on this way and 2 degrees up and 2 degrees down, for instance. Many Gulf states peg their currency to the US dollar. A dirty float exists when a currency tries to hold the value of its currency within some range of reference currencies such as US dollar. The gold standard, first of all, these are the different currencies exchange rates. And before we start, we had discussed about the gold standard, which initiated and which can be traced back to the ancient time, that the exchange rate across the countries were determined on the basis of gold standards. Gold standard refer to a system in which countries peg their currency to the gold and guarantee their convertibility. In the 1980s, most nations followed the gold standard. 1 pound is equal to 23.22 grains of fine pure gold. The gold par value refers to the amount of a currency needed to purchase 1 ounce of a gold. Each government decide about that if they want to buy a 1 ounce of gold, how much they have to pay. That will be the value of that currency. And then at the time when they have to exchange the exchange rate across the countries, then they have to take the values of that thing. The amount they pay to buy 1 ounce of gold in country A, and the same amount they pay to buy the 1 ounce of gold in country B. They exchange on the basis of that rate with each other. An important thing is when they decide about this, when they print their money, when they do this sort of exchange, or when they do make the monetary policy, they have to print only that number of notes or that number of currency which should be backed by the gold reserve with the government. In 1944, representatives from the 44 countries met at Bretton Woods, New Hampshire, to design a new international monetary system that would facilitate post-war economic growth. Under the new agreement, a fixed exchange rate was established. All currencies were fixed to gold, but only the US was directly convertible to gold. Devaluation could not be used for the competitive purposes. A country could not devalue its currency by more than 10% with the IMF approval, and the IMF and World Bank were these two institutes were established. Okay, in 1944 they introduced a new exchange rate system, and this exchange rate system is called a fixed exchange rate system. Under this system, what they did that before under the gold standard, every country has to maintain the gold reserves, but under the fixed exchange rate system, only it goes like this, that all currencies have to be maintain their exchange rate with reference to dollar, and dollar should be backed by the gold standards. This is these are the two things, important thing. Next thing is like what happened in before the Second World War, that to attract the investment and to increase the employment opportunities within the countries, USA started to devalue its currency, and subsequently after seeing that US did it, other countries followed the US and they devalued their currency as well to attract the investment and to increase employment. But the net effect of all this devaluation, competitive devaluation, was zero. The companies were not getting the competitive advantage to go some specific country to avail the low currency rate. But when they fixed the in Bretton Woods, one new clause was that devaluation could not be used for competitive purposes. They tried to stop this competitive devaluation. And the next thing what they did, if some country wants to devalue its currency, but because of these monetary pressures, they can do this thing only with the approval of IMF. And the next thing is, because of this meeting, they established two international institutions, IMF and World Bank. The purpose of IMF to provide the loans for monetary policies of the government to fix, and especially the purpose of IMF to maintain the monetary policy of those member countries in such a way that they should maintain the fixed exchange rate. If their exchange rate is going up or down, IMF is going to help them to maintain and standardize that exchange rate. And secondly, the World Bank was established to provide the development loans to the countries who were really affected because of Second World War. Okay. The Bretton Woods system could not work if it's okay. There are certain assumptions, not the assumption. We should say there are certain underpinning fundamentals or basis. The foundation of this foreign fixed exchange rate was that US dollar should not come under speculative attacks, and US inflation should remain low, and US did not run balance of payment deficit. These are the three fundamental things that this system should follow. US economy should be strong, and US economy should stable, and US economy should not face the inflation, should not be export, should not be less than import, and the third thing is that these countries, these are the different fundamental things that they try to make the basis for the fixed exchange rate. But later on, what they established, what they have observed, that during the Vietnam War, because that government, the US government, needed the extra expenditure, they wanted to provide some welfare facilities to their citizens. They printed money without the backing of some resources, and instead of generating the revenue from those capital, that money that they use for war and those welfare purposes, rather than generating that money from the tax revenues, they just printed out that revenue that money and just use that money for that purpose. And because of this thing, the US dollar was devalued, and that came under the speculative attacks, especially in the European Union market, especially in the France and German market. In the backdrop of these fundamental flaws, in 1976, the member countries, they sit together again in Jamaica, and they formalized a new exchange rate system which was termed as floating exchange rate system. The rules that were agreed on then are still in place today. Under the Jamaican agreement, floating rate were declared acceptable. Gold was abandoned as a reserve asset even for the US dollar, and total annual IMF quotas were decided, and the amount that member countries were contributing for IMF were raised from 41 billion US dollar to 300 billion US dollars. Okay, now the question, the academia and the people, the investors, the companies, they were discussing and they were debating about which system was better, and the floating exchange rate system or the fixed exchange rate system. Monetary policy, and under the floating exchange rate system, the people who argue for the benefits or the in support of the floating exchange rate system, they are saying that monetary policy autonomy is availed under floating exchange rate system. Under the monetary policy autonomy, what happens that it removes the obligation to maintain exchange rate parity, restores monetary control to a government. Mean rather than external IMF or the other countries are going to control your monetary policy, government control its own monetary policy under the floating exchange rate system. Second one is under the floating exchange rate system, the balance of trade balance adjustment happens automatically. But on the other hand, fixed exchange rate system provides monetary discipline, ensures that governments do not expand their money supply at inflationary rate, and minimizes speculation and reduce uncertainty. Okay, we continue our discussion about which one is better and how this system is better, and we are going to start our this discussion after this lecture with the pros and cons of both systems. Like we said that the floating exchange rate system gives monetary policy autonomy. It gives the autonomy to a local government to decide its supply of money by itself. Means supply of money, which of course in fact on the exchange rate, it will be determined. It will not be determined by the IMF, or it will not be determined by the overall the member countries of Bretton Woods. Rather, what is going to happen, and this thing, when monetary expansion happens, when supply of money increases, the inflation will go up, and when inflation go up, the devaluation of the currency will occur. This is the regular flow of this thing. On the other hand, if we say that the monetary contraction happen, mean governments pull back the money from the system, then it's inflation, the opposite or the reverse of inflation will happen, and the currency will appreciate. And the other hand, if we see this thing that higher interest rate, if the country increases the interest rate within the economy, what's going to happen? Foreign investors are going to invest, foreign investor will be attracted because of this fact that interest rate is higher in the economy. Higher interest rate leads to the attraction of the money from the abroad, injection of the foreign capital, which will lead to appreciation of the currency. This is the flow of monetary policy, and that's how government controls its monetary policy, and that's how government can the independence of the monetary policy will be achieved through the floating exchange rate. Okay, the next one is under the floating exchange rate, trade balance adjusts automatically. Okay, under Bretton Woods, if a country develops a permanent deficit in the balance of trade that could not be corrected by domestic power, IMF would have to agree on to a currency devaluation. Mean in the floating exchange rate, the government does not have to consult to IMF to devalue its currency. Rather, what they can do the devalue of their currency by themselves. Okay, if country is running in deficit mean import is more than export, what's going to happen? Supply of money, supply of import is more, mean supply of money is higher. Country is importing, and importing mean money is going out of the country, or mean the supply of money is low. When the country is in deficit, supply of money will go down, and the demand of products, demand of that currency, or demand of that currency will go up, and that will lead to devaluation of the currency. And another thing, when the devaluation of the currency will occur, the export become cheaper, and so export will increase and import decreases. Do you understand this thing, that how it goes, how these things are interrelated with each other with the currency exchange rate? When the currency is devalued in certain country, if the exchange rate is low with the certain currency, what's gonna happen, that export, when the country is exporting their products, the price of that product will be lower in terms of when they are converting their currencies. In the case of devaluation, export will be cheaper, and because the export is cheaper, people will do more export and then import, because import will be more expensive. That's the effect of when that important thing is, this exchange rate automatically increases or decreases the import or export, the trade balance. It automatically adjusts the trade balance, and the country don't need to ask from the IMF. They don't need to take the permission from IMF when they have to adjust the trade balance. Okay, on the other hand, the proponents of fixed exchange rate, they say that the fixed exchange rate system provides a monetary discipline. How they provide the monetary discipline? It ensures that governments do not expand their money supplies at inflationary rate. Mean government will not provide, they are not going to just print the money to provide more money to the people. They are not going to do that, because they have to align their exchange rate. They have to keep their exchange rate fixed at the specified rate. And the second thing is, it minimizes the speculation from the investors or opportunistic people and opportunistic investors. And like what happened in 1980s, they have seen this thing, that under the fixed exchange rate, speculators, they couldn't disturb the exchange rate across in the Europe. And the third point is, reduces uncertainty, because the third point is interrelated with the second point. When there is a speculation will minimize, then of course the uncertainty will be reduced as well. It promotes growth of international trade and investment. Of course, when there will be low uncertainty in the economy, the foreign investor will come into the country, and overall it will affect positively on the growth of the economy. Okay, which type of system is better? Now there is still a debate about fixed versus floating exchange rate, and the point is, because of the volatile nature of the floating exchange rate, there has been renewed interest in a fixed exchange rate in recent years. Because of this recent financial crisis in floating exchange rate, countries who are doing the floating exchange rate, they experience the financial crisis, the bank crisis or currency crisis in recent years. And because of this thing, the people are still they consider this thing, that they have to follow the fixed exchange rate rather than floating one. And mostly these financial crises, especially the currency crisis, occurred because of the investors' speculations. It's hard to say whether a fixed exchange rate is best or a floating exchange rate system is better. A floating exchange rate system offers monetary policy autonomy and the automatic trade balance adjustment that we had seen. Supporters of floating exchange rates note that governments gain control over the monetary policy when they don't have to maintain exchange rate parity, Why this is important? Well, suppose the government wanted to stimulate domestic demand to reduce domestic investment. What they have to do under the floating exchange rate, let's assume when they have to increase the employment under the floating exchange rate, the government could choose to expand the money supply to encourage people to buy more without worrying about maintaining the exchange rate with the foreign countries. But under the fixed exchange rate system, the government does not have its ability to, because it has to maintain exchange rate parity. In order to increase the employment, government can inject the money and they can increase the money supply in the economy to increase the buying power of local people. This can under the floating exchange rate they can do this thing, but under the fixed exchange rate they cannot do this thing because they cannot inject the money, they cannot increase the supply of money because they have to maintain the parity, exchange rate parity with the other countries. In addition, educates the floating exchange rate point out the automatic trade balance adjustment that are part of the system are important. While under the exchange rate system, if a country does not correct a balance of payment deficit using domestic policy, it was required to get IMF approval to devalue its currency. Under the floating exchange rate, the trade balance would be automatically corrected. For instance, if a country is running a trade deficit, buying more than its sells, the outflow of money will eventually lead to a depreciation of currency. This depreciation will make its goods cheaper in the foreign market and imports more expensive, and trade deficit should eventually correct itself. We have discussed this thing in the last slide with the arrows, and we had discussed this thing that when a currency is running in trade deficit, the currency will lead to depreciation of the currency, and this depreciation will make goods cheaper in the foreign market, and in the foreign market imports more expensive. It will cheaper, export will be cheaper and import will be more expensive, and trade deficit should eventually correct itself. Now, which side is correct? Who's saying in the right way? There is no real agreement as to which system is better. We know that a Bretton Woods style fixed exchange rate regime will not work, but a different kind of exchange rate system might be more enduring, could encourage stability that would facilitate more rapid growth in international trade and investment. These are the simple things. What type of exchange rate in current period, what different sort of exchange rates these different current countries are observing. The first one, 14% of IMF members follow a free float policy. 26% of IMF members follow a managed float system. 22% of IMF members have no legal tender of its own, like the EU zone countries. The remaining countries use less flexible systems such as pegged arrangements or adjustable pegs. The remaining countries the China and Russia. They use this thing that they use to flexible systems and the peg arrangement, and under the peg arrangement they have dirty floating. That's a very common thing, and USA very commonly, and along with the European Union, they very commonly accuse China to do the dirty floating, that they deliberately undervalue their currencies to attract more imports in their country. Okay, what is a peg rate system? A country follow a peg exchange rate system, pegs the value of its currency to that of the another major currency. The popular among the world's smaller nations, imposes monetary discipline and leads to a low inflation. Adopting a peg exchange rate regime can moderate inflationary pressures in a country. How peg goes? It goes in this way that, for instance, if we are doing pegging with the USA, with the US currency, it will go like this. We fix our exchange rate of $1 is equal to 100 rupees, and if dollar goes down, our currency will go down in a similar ratio. and if the dollar goes up, our currency will go up in a similar ratio. We are pegging, in the same way we are following the same pattern as that currency is doing. Nowadays the small countries, small nations, they are following this sort of pegging exchange rate system. It imposes monetary discipline and leads to low inflation. The benefit of this pegging is it imposes monetary discipline. Monetary discipline means that inflation and the interest rate and the employment, these three things which are interrelated with each other, these will be more maintained and under control, and all these things will lead to low inflation. Adopting a pegged exchange rate regime can moderate inflationary pressure in the country. It will be under the protection of the bigger currency, and if that, most probably the bigger currency is going good, that currency will automatically get the benefit of that, the price of that currency. Okay, what is a currency board? Countries using a currency board commit to converting their domestic currency on demand into another currency at a fixed exchange rate. The currency board holds a reserve of foreign currency equal at a fixed exchange rate to at least 100% of the domestic currency issued. Okay, the currency board holds reserve of foreign currency equal to at a fixed exchange rate to at least 100% domestic currency. Currency board, China and Hong Kong, they use this system. They always maintain, they have a currency board, and the currency board does, in fact, that they use to keep whatever the money they produce within the country, however much they produce within the country, they keep, rather than keeping the gold or something, they keep the foreign reserve of a foreign currency with them. They reserve the foreign currency equal to the fixed exchange rate at least 100% of the domestic currency issued. Fixed exchange rate के ऊपर they are going to maintain a foreign currency as a backup in equal amount of the domestic currency issued. Currency board can issue additional domestic notes and coins only when there are foreign exchange reserve to back them. This is the important thing. Just like what used to happen in gold standard, they used to have a backup of the gold when they are issuing the currency. In a similar way, the currency board countries which are having currency board, they used to have a backup of foreign currency, and mostly these countries have the, in terms of dollar, euro and pounds. Okay, what is the role of IMF? The next thing, that two institutions which they made back then in 1944. The first one was the IMF, and the next one is the World Bank. Today the IMF focus on lending money to countries in financial crisis. There are three main types of financial crisis. The first one is the currency crisis, the second one is the banking crisis, and the third one is the foreign debt crisis. A currency crisis occurs when a speculative attack on exchange value of a currency results in a sharp depreciation in the value of a currency, or forces authorities to expend large volumes of international currency reserves and sharply increase the interest rate in order to defend prevailing exchange rate. In currency exchange rate, what happens that the speculators, investors who speculate about the currency, they made this sort of attacks in a way that they speculate. Large one firm or large group of investors, they speculate about certain currency, that this currency is going to devalue sooner in the future. What going to happen? They are going to start selling that currency in the market. We had discussed this concept of bandwagon effect. When these major group of investors, they start selling the currency, the other market, the investors were sitting in the same market, they started doing the same thing. Like for instance, it usually starts like the Asian crisis. It start from the USA, what happened in the Indonesia And Thailand, the US investors, they start doing this thing, and they started selling their currency, and later on the US investors started this thing, and they started selling the currency, and later on it's this effect, the bandwagon effect, expanded to the European market, and even in the European investors, they start selling this thing, their currency. When the amount of currency increased, the supply of currency increased at a greater extent, of course we know this thing, the value of that currency will depreciate, and this is what exactly happened. And when they depreciate at a larger extent, this is called the currency crisis. Okay, on the other hand, when the governments, when they observe this thing, that certain their currency is under the speculative attack, what they do, they, rather than when the foreign investor, they start selling their currencies, what they do, governments start to buying that currency from the domestic market, from there, and to keep the supply of currency within the market low, to keep that level low in the market, the supply level low in the market, they start buying this thing, and rather than providing more foreign currency in the market to keep the balance, keep the same exchange rate. And the second, and the another way the government what can do, they can increase the interest rate in the country. Why they do that? These are the two ways they do that. Either they start buying the domestic currency, what the other speculators, the investors, the opportunistic investors, what they do, they are selling and government is buying. This is the one way, and buying the local currency and try to reduce the supply of the local currency, and try to increase the supply of the foreign currency within that market. And the second thing government can do, when they start selling the selling that currency, what the government can do, government can increase the interest rate. What is the benefit of increasing the interest rate? When the interest rate will be increased in the local market, like if we take the example of Thailand, when the US investors started, or the foreign investors started to sell the Thai baht, the government could buy those Thai bahts and try to reduce the supply of Thai baht within the economy. That was the one way. And the second way they could do that, they increase the interest rate within the economy, within the Thailand. What is the basic purpose of increasing the interest rate? Is to encourage the investors to come in the currency in the country and use this money, and they are going to borrow this money, to get this money from the Thailand. I mean, they are of course they are after the higher interest rate, they are after more money. In order to do so, they will increase the interest rate, and they are giving more money on the borrowing. And what is the purpose of this thing? To reduce the supply of Thai baht from the local market, and they are giving away this money as a loan to the foreigners or to the local investors. I mean, this is the basic purpose, to reduce. When the supply of currency increase, the government starts try to reduce the supply of that currency within the market to counter the currency crisis. Okay, the bank crisis, and the another type is the first we had discussed about the currency crisis. The next one is banking crisis. Banking crisis refers to a situation in which a loss of confidence in the banking system leads to a run on the banks as individuals and companies withdraw their deposits. A foreign debt crisis is a situation in a country cannot survive. Banking crisis. Banking crisis is a crisis when investors or investor who invested in the money, investors can be the individual people or the company, they lose the confidence from the banking system, and they start taking out their own deposits from the banks. What going to happen about this thing? Banking crisis being, of course, when we individual and the companies, when they withdraw their money from the banks, and the banks are nothing without our money. They cannot survive without our money, our deposits, and that situation is termed as the banking crisis. And this is the mean, this thing, the banks are the pivot point within the economy. They take money from us and then they lend this money to the investors, to the individual, to for the further investments, to keep this cycle moving. And they are going to banks are getting the money from us, and they are lending money to the industries, and the investors, they are making more, they are installing the industries, production units, and this and that, and it will also gives us the job, the growth opportunity, the overall growth of the economy, and this and that. All these things are dependent on the role of the banks, and the money of the people. And when the banks don't have the money, the whole system will collapse. And this situation is termed as the banking crisis. The next one is the foreign debt crisis. Foreign debt crisis is a situation in which a currency cannot service its foreign debt obligations by the private sector or the government debt. Foreign debt crisis is like this, that country used to have foreign debts from the foreign countries. When they cannot pay back their loans. This is simply, in the simple term, this is called the foreign debt crisis. The Greece and the Ireland in 2010 are the best examples of the foreign debt crisis. Okay, there is one famous crisis, currency crisis of Mexico in 1995, which was a result of high Mexican debts, a pegged exchange rate that did not allow for a natural adjustment for prices. To keep Mexico from defaulting on its debt, the IMF created a 50 billion aid package, required tight monetary. Okay, in 1995, the Mexican economy experienced the currency crisis. Under the currency crisis, among other reasons were the first one is the high Mexican debt. The second one, they call it that all of a sudden in 1994 they made the NAFTA agreement, and because of the NAFTA agreement, a lot of money investors and multinational companies entered in the Mexico, and a lot of capital entered in the economy, and there was the whole economy experience of investment boom within the economy, and they couldn't handle because of the peg exchange rate system. The prices, that system, because of that strictness with the exchange rate, the prices could not adjust automatically, and because of these two main reasons, the currency crisis occurred in Mexico. And in order to control, or in order to reduce the negative effects of this currency crisis, IMF lent them 50 billion US dollars aid package. And of course, against this sort of loans, IMF always asks for the stringent policies and the cuts in the public spendings. These are the normally required things that the IMF demand against their loans. Another example of the currency crisis is the 1997 Southeast Asian financial crisis, which was caused by the events that took place in previous decade, including the investment boom fueled by huge increase in export, excess capacity. Investments were based on projections of future demand conditions, and the third one is high debt, and the fourth one is expanding imports. Okay, the second famous Asian currency crisis that we have seen is the Asian currency crisis in 1997. The Southeast Asian countries, they experienced this thing, and there are four major reasons for this sort of crisis. The first one is the investment boom fueled by huge increase in exports. These countries have experienced a huge injection of money, and all of the multinational companies, they invested in those Southeast Asian countries, and because of the cheap labor and cheap resources. And the next one is excess capacity. Investments are based on the projections of future demand conditions. These investments were based on the future demand creation. They were not realistics. The third one is the high debt. Investment were supported by dollar-based debts. These okay, and the fourth one is expanding import. Cause current amount deficit. Imports, because of this, in order to increase the export, the level of imports were also increased. By mid-1997, a key Thai financial institutions were on the verge of default. Speculation against the Thai baht, and Thailand abandoned the baht peg and allowed the currency to float. Because of this currency crisis in 1997, Thailand allowed this currency to float freely, and they stopped pegging their currency against the US dollar. And to survive that currency crisis, the IMF lended 17 billion US dollars as a bailout package to Thailand. And against this package, they asked for higher taxes, public spending cuts, privatization of state-owned businesses, and higher interest rates. If we see this thing, that the strange thing, if we see or if we compare our country's situation, what we are observing nowadays, or since might be from the beginning of the country, that whenever we borrowed the money from the IMF, these are the important points that mentioned in the last line. We are experiencing the same thing. Required higher taxes against the IMF loan. They are always demanding the higher taxes, and the second thing, public spending cuts. Public spending cuts mean the subsidies should be omitted. Like nowadays, or since 2 decades, I guess, that every time they are reducing the subsidy on the electricity, on the gas, on the water. They are trying to reduce the subsidies on these sort of things. And privatization of state-owned businesses, we are experiencing this thing as well, to generate the money. And the second aspect of state-owned business, privatization of state-owned bank, the argument they say that state-owned institutions are not doing enough, and their performance is not up to the level of the private institutions. But in fact, what the purpose of this thing is to reduce the welfare of the local people. I mean, this state-owned, the main intention of the state-owned institution is the welfare of the society. And when we don't have the welfare, these state-owned institutions, of course, if these institutions are privatized, then of course that their intention would be the making money, and they will not think about the welfare of the people. For instance, take the example of the railway, or just imagine that if railway is doing good and they are providing, the people can travel across the cities at the cheaper rate. And imagine if it get privatized, what's going to happen? People, the higher rates, and people will be directly affected because of this sort of privatization. The last thing is high interest rates. Interest rate, people, it's very difficult for people to borrow from the government, and it will be really difficult for the local people to take the money and do some sort of investment or start some business. Okay, because in Asian crisis, Southeast Asian financial crisis, IMF supported these countries, especially the country of Indonesia, with 37 billion US dollars aid package. And again, they asked for the same thing: required public spending cuts, closure of troubled banks, a balanced budget, and an end of crony capitalism. Crony capitalism is a system where only the relatives or the family members or the family and friends, they are getting benefit from the system. People who have relationship with the bank, they are getting loans. People who have the relationship with the government, they are getting the contracts, they are getting the subsidies, they are getting every benefit. Everything, these monopolies, these licensing, these subsidies, these foreign contracts, I mean, everything will be provided to, and the government support, government bailouts, these things will be provided by the provided to the only the relatives and the family and friends. This sort of system is termed as crony capitalism. And the IMF provided a 55 billion US dollar aid package to South Korea, required a more banking system and economy, and restrained by the Chaobal. Chaobal is the conglomerate, is the name of the business groups in South Korea. Like in India, these are the business groups are called business houses, and in South Korea it's called Chaibal. And in Pakistan, we also in the era of 70s, Dr. Mahbub al-Haq termed these business houses as the 22 business groups. By 2010, the IMF was committing loans to 68 countries in economic and financial currency crisis. In total, if we talk about the performance of IMF till 2010, IMF has lended 68 countries different sort of loans in order to combat the economic and currency crisis. All IMF loan packages require tight macroeconomic and monetary policy. This is what we discussed. They do that. However, critics worry that the one-size-fits-all approach to macroeconomic policy is inappropriate for many countries. There are several objections people raise for the role of IMF, that these financial crises are the countries, especially the African countries or the developing countries like Pakistan, they are still, after 70-80 years, they are still developing countries, and they are still fourth world countries like African countries, least developed countries in the world. And the main reason they say that all credit goes to the IMF because of their tight policies and their requirements, what they ask for. And one of their structural drawback of their policy is the one-size-fits-all approach to macroeconomic policy. I mean, might be the policy which is suitable to one country, they want the same measure, same requirement from the other country as well. The next one is IMF is exacerbating moral hazard. More people behaving recklessly because they know they will be safe if things go wrong. The second thing they say that despite IMF observing this thing, that the people, there is a crony capitalism and people are and the corruption, and the people are just destroying the money that IMF provide them as a loan. They just disappear within the hands of the elite people. Even then, IMF keep providing them loan. This is the second reason. If we see this thing that I mean, it's debatable thing, but if we see this thing in African countries, despite that a lot of African countries are under the dictatorial autocratic regimes, and under they are in war situation, even then IMF is providing them loans, and IMF is providing them they keep providing them loan with those terms and conditions. These critics, they say that IMF just want to just give them loan to keep them bound with their terms and conditions, to keep them they claim this thing, this is a new system, new colonialism system, that under which IMF or these developed countries, they don't have to sit directly or rule directly to those countries, those developing countries. Rather, what they can do, they can control those developing countries or least developing countries, third world countries, through the strict requirements, through the IMF, through the controlling their monetary policy. If you control their monetary policy, automatically the whole country is under your control. That's what these critics say about IMF. IMF has become too powerful for an institution without any real mechanism for accountability. I mean, this IMF has become too powerful for an institution. I mean, IMF has too got the too powerful. I mean, this is what we are talking about, that still if we see this thing, if we don't find these people, according to those people, since they established IMF in 1944. Since 1944 they haven't provided, the people of IMF, they couldn't provide a single example of any country who got benefited, who changed their status from developing to developed country because of IMF. If we see certain countries like the BRIC countries, Brazil, Russia, India, China, or South Africa, these countries, they are changing their status from developed and developing country to from emerging economies. Or if we see certain countries like former Soviet Union countries, they have changed their status from developing countries to transition countries. All these countries, those are changing their status. They are not because of IMF. The countries who are engaged with IMF, they are still in the same situation, or they are in worse than before. This is the main critics of IMF, that they couldn't survive even a single country since, I guess, over 70 years. But as with many debates about international economics, it is not clear who is right. However, because IMF people, they have their arguments as well. They keep arguing about the benefits of IMF of providing and showing the positive aspects of those loans, and on the other side, the people who are against IMF loan, they define the prescription of poverty, IMF loan as a prescription of poverty. This is what they termed as. However, in recent years, IMF has started to change its policy and be more flexible, and urge countries to adopt fiscal stimulus and monetary easing policies in response to the 2008-9 global financial crisis. Turkey's and IMF explored Turkey's 18th IMF program in May 2001. IMF agreed to lend $8 billion to Turkey to help stabilize its economy and halt a sharp slide in the value of its currency, to maintain its currency exchange rate. While initially the Turkish government resisted IMF mandates on economic policy, in 2003 the government passed an austerity budget. By 2005 significant progress has been made, and today the country appears to be back on track for recovery, with lower inflation rate and increase in privatization and budget surplus. Okay, now the question is, what is for the managers? Whatever we have, the things that we have discussed in today's lecture, what is the lesson for the managers? And managers, there are three separate lessons for the managers. The first one is a manager need to understand that how the international monetary system affects currency management, because the international managers have to deal with the currency management. The currency system is managed float. Government intervention can influence exchange rate. If the managers should know this thing, that if there is currency floating exchange rate, or fixed exchange rate, or pegging exchange rate, or dirty floating exchange rate, whatever the system they are following, the managers should know this thing, and they should be aware of this fact that government can intervene the exchange rate at any moment. And speculations can also create volatile movements in the exchange rates. They should be aware of the speculative movements that can disturb the exchange rate. The next one is the business strategy. The manager should, because of the exchange rate movement, exchange rate movement have a direct effect on the competitive position of the business, and which will affect on the business strategy. Need strategic flexibility. Companies should be ready for any change, for static change, because of this exchange rate fluctuation. The third one is the corporate government relationship. Business can influence government policy towards the international monetary system, and companies should promote a system that facilitates international growth and development. These are the three important areas where managers should be focused on when they talk about the exchange rate, and especially the currency management, the business strategy, and corporate government relations, where businesses can affect the government's decisions about what they do and how they are going to decide the rate of the currency. Airbus and Euro describes how Airbus is protecting itself from exchange rate fluctuations. French aircraft maker Airbus prices its planes in dollars. However, because over half of the company's cost in euros, the company has the potential to see significant fluctuations in its earning. If it does not hedge its foreign exchange exposure, it will be destroyed. It's trying to say this thing, the Airbus, the half of the production or the operations are undertaking in the USA, and the remaining stuff they are doing in the in the France or in the Europe. And what they are saying this thing, that because there are different currencies that are involved, and because of the fluctuation of exchange rates can severely affect on their operations. Okay, there is small case study of glass menagerie. What you have to do is this is a small case study and really interesting case study. This is the case study about a student who is living in USA, but actually that student belongs to Swaziland in Africa. And this case study tells about that how this student initially started his business and how exchange rate affects on its business, and from start to the mature stage. And this guy started their business from on the trial basis, on the test basis. He started to import some glass animal figures from Africa to USA to start. He started just to present that those glass figure animals as a gift to his friends in the beginning. In the next stage, he thought that people like here this cultural stuff, and he started to sell his stuff in USA. And gradually, when he saw this thing that there is a huge demand, and there are some, but importantly, he has to observe the cultural differences. Like in the case study, they have discussed this thing that all the animal glass figures were acceptable. They were in the huge demand in the USA, except for the elephant, having elephant, because there is some sort of a cultural difference about the perception of that elephant in the USA and in Thailand about their position of about their trunk. And in USA might be it was considering as a bad luck, but on the other hand, in the Africa it was totally symbolic, and it was okay. But important thing is he acknowledged and he focused on the cultural heritage stuff his own from Africa and in the USA, and he started to sell that stuff in the USA. And this is really an interesting case study. And what you guys can do, you can read this case study and apply the concept, especially the exchange rate concept, and on this case study, and you can see this thing how floating and fixed exchange rate can influence the business. Okay, there is a summary of a lecture. We had discussed about the floating exchange rate and the fixed exchange rate and the pegging and dirty floating exchange rate. And then we had discussed about the currency crisis. We discussed the three types of currency crisis, the three types of crisis: the currency crisis, the banking crisis, the foreign debt crisis. In currency crisis, we have seen about the currency crisis occurs when the speculative attacks on the exchange value of the currency results in the sharp depreciation in the value of the currency, or forces authority to expend large volume of international currency reserve and sharply increase the interest rate. Similarly, we have seen the banking crisis and foreign debt crisis. In the currency crisis, we have seen the Mexican currency crisis in 1995, and then in 1997 we have observed the Thai financial institutions which were collapsed because of this speculative attacks. And all these countries and these financial crises were supported by or backed, or we can say that IMF rescued these countries and they provided some bailout packages. And however, the critics worry that IMF policy have some drawbacks. The first one is a one size fits all. This is the one negative aspect of the IMF package. The next one is the IMF is exacerbating, is boosting or encouraging the moral hazard. Moral hazard is a concept when people behave recklessly, more brutally or more corruptly, because they know that they will be saved if things go wrong. IMF will come and IMF is going to provide the loan and they are going to bail out. And IMF has become too powerful for an institution. As an institution, IMF is too powerful. It's controlling the monetary power in the country's whole economic situation of the countries. Okay, what's in it for the managers? The managers should know about the currency management, how the currency will be managed, and when the fluctuation will occur, and the business strategy. And the business strategy should be flexible. And the third one is the business-government relations. The business can influence the government policies, monetary policy, when they decide about the exchange rate. Okay, this was these are the things that we had discussed today. Thank you for today. Allah Hafiz.